Alright, listen up. It's 2025 and the market is a wild beast, a jungle filled with opportunities and traps. You, the home gamer, are out there every day trying to find that next big winner. You're looking for the stock that's going to make you some real money, the one that's going to explode and change your financial future. But let me tell you, it's not easy. For every stock that goes to the moon, there are a dozen that crash and burn. That's why you need a guide, someone who's been in the trenches, someone who knows the game. And that's why I'm here. I've done the homework so you don't have to. We're going to look at a list of stocks that have been buzzing, the ones people are talking about. We've got a diverse lineup for you today. We're talking high-end ski wear with Perfect Moment, ticker PMNT, a pharmacy tech play with SRX Health Solutions, ticker SRXH, and some wild biotech gambles like Biotech, ticker IOBT, Precigen, ticker PGEN, and Matinas Biopharma, ticker MTNB. Then we shift gears to energy with Pioneer Power Solutions, ticker PPSI, and Sunrun, ticker RUN. Finally, we'll check in on an old name trying to make a comeback, FOSL Group, ticker FOSL. Now, before we dive in, let's set the rules. I'm not just going to give you a stock ticker and say buy, buy, buy. That's for amateurs. We're going to break down each company. What do they do? What's their story? What's the news that's making the stock jump around like a cat on a hot tin roof? Most importantly, we're going to talk about risk. Every single one of these stocks has risks, and you need to know what they are. Let's get ready to make some money. Booyah! First up is Perfect Moment, ticker PMNT. This isn't your average clothing company, folks. This is a luxury lifestyle brand that focuses on high-end ski wear and surf wear. Think fancy ski jackets, stylish snow pants, and gear that you'd see on the slopes of Aspen or St. Moritz. They sell their products through their own website and high-end retailers. The idea here is that the wealthy will always have money to spend on premium experiences and the gear that goes with them. It's all about aspiration and brand power. Now let's talk about the stock's action. PMNT has been a roller coaster since it went public. We've seen this thing pop and drop, a classic small cap story. The stock saw a nice little jump earlier this year from around $1.50 to over $3, but it's since given back some of those gains, now hovering in the low $2 range. They haven't yet proven they can consistently turn a profit. This is a major red flag for conservative investors. They are in what I call the prove-it stage. If the economy takes a downturn, expensive ski trips are one of the first things people cut back on. For me, this is a sell for new investors. It's too speculative. But for most people, it's better to watch this one from the sidelines. Next, we have SRX Health Solutions, ticker SRXH. Now this one is interesting. Pay attention. SRX is not a drug maker. They are in the pharmacy technology and services space. Think of them as the plumbers of the healthcare system. They provide software and tools that help pharmacies manage their operations, process prescriptions, and handle all the complicated billing and insurance stuff. This is a business that's all about efficiency. As healthcare costs continue to rise, everyone from small independent pharmacies to big hospital chains is looking for ways to cut costs and improve service. That's where a company like SRX comes in. The stock, SRXH, has been on a wild ride. This is another small cap name that has seen some big swings. Over the past year, it's been a battleground stock. It traded below $1 for a while, then some positive news sent it soaring. We saw it spike to nearly $4 earlier this year, on the back of strong quarterly results that beat expectations. But the momentum didn't last, and it's pulled back to the $2.50 level. Historically, SRX Health Solutions has struggled with profitability. They are investing heavily in research and development, sales, and marketing to capture a larger piece of the market. This means they are burning through cash now in the hopes of generating big profits later. The big question is whether they can scale up their operations and finally achieve consistent profitability before they run out of money. It's a race against time. So, what's my verdict on SRXH? This is a speculative play, but it's in a much more compelling industry than a luxury ski brand. I'm calling this one a hold. For new money, I'd wait for another quarter or two of solid results to prove the turnaround is real before jumping in. Alright, let's get into the biotech arena. This is where fortunes are made and lost overnight. Our first contender is Biotech, ticker IOBT. This is a clinical stage biopharmaceutical company. In plain English, that means they are developing new drugs but don't have any products on the market yet. They're focused on creating therapies for rare diseases and cancers, which is a hot area in medicine. The whole story here is about their drug pipeline. They have a few promising candidates that are in early to mid-stage clinical trials. If just one of these drugs gets approved by the FDA, the stock could go from a few dollars to hundreds of dollars. It's a lottery ticket. IOBT's stock chart looks like a heart monitor. It's full of sharp spikes and steep drops. These moves are almost always tied to news about their clinical trials. A press release about positive data from a phase 1 trial can send the stock soaring 100% or more in a single day. On the flip side, news of a trial failure or a delay can cut the stock in half. When you look at the financials for a company like Biotech, you won't see any revenue or profits. All you'll see is cash burn. These companies spend tens of millions of dollars a year on research and development without a single dollar of sales coming in. Their survival depends on their ability to raise money from investors to fund their operations. They do this by selling more stock, which can dilute the value for existing shareholders. My call on IOBT: this is the definition of a high-risk, high-reward investment. For a new investor, my advice is crystal clear: sell, stay away. You have no business being in a stock like this until you have years of experience and a portfolio that can handle a total loss on a position. If you want to gamble, go to Las Vegas. The odds might be better. Let's stick with the wild world of biotech and look at two more names: Precigen, ticker PGEN, and Matinas Biopharma, ticker MTNB. I'm grouping these because they represent the classic biotech gamble, but with different flavors. Precigen is a gene and cell therapy company. They have this really cool technology platform called UltraCAR-T, which aims to create cancer treatments that are faster and cheaper to produce than existing therapies. Like IOBT, their success hinges entirely on getting one of these advanced therapies through the grueling FDA approval process. It's a moonshot, but a potentially revolutionary one. Matinas Biopharma, on the other hand, is focused on a different problem: drug delivery. They have a technology they call the LNC platform, which is designed to deliver drugs, including potent antifungal and antiviral agents, more effectively and with fewer side effects. While it might sound less glamorous than curing cancer, solving the drug delivery puzzle is a massive market. It's a different kind of biotech bet, one based on a platform technology rather than a single drug. Both PGEN and MTNB have stock charts that will give you whiplash. These are penny stocks, folks, meaning they trade for under $5 a share. PGEN has been trading under $2 for a while, and MTNB has been stuck under $1. These stocks are extremely volatile and can double or get cut in half on any given day based on clinical trial news, FDA updates, or even just rumors. They are constantly burning cash and often have to raise more money by selling shares, which puts pressure on the stock price. So, the verdict on these two, both Precigen and Matinas, are binary bets. They will either work out in a spectacular way, bringing life-changing returns, or they will fail and the stock will go to zero. For any new investor, the answer has to be a resounding sell. Do not touch these stocks. You are far more likely to lose your money than you are to hit the jackpot. Leave these to the professional speculators who can afford to take a total loss. Alright, let's get out of the science lab and onto the factory floor. Let's talk about Pioneer Power Solutions, ticker PPSI. This is an industrial company, a nuts and bolts business that I love. They design and manufacture electrical transmission, distribution, and generation equipment. Think big metal boxes, switchgear, circuit breakers, and transformers that manage the flow of electricity. More recently, they've made a big push into the electric vehicle charging market. They are making the charging solutions for electric trucks, buses, and cars. This is the picks and shovels play on the EV revolution. You're not betting on one car company, you're betting on the infrastructure that all of them need. PPSI is a small company and its stock reflects that. It's been volatile. We saw this stock run from around $3 to over $12 back in late 2021, when the EV infrastructure hype was at its peak. Since then, it's come back to earth and has been trading in a range between $4 and $6 for the past year. What moves this stock? Contracts. A few months ago, they announced a big new order for their E-Block charging solutions, and the stock popped 20% in a day. They are slowly building a backlog of orders, which gives you visibility into their future revenue. It's about execution now. The company has had periods of profitability, but like many companies investing in a new high-growth area, their expenses have been high. They are building out their manufacturing capacity and spending on sales to win these new EV charging contracts. The key here is to watch their gross margins. So, what's the call on PPSI? I like this one. I really do. It's speculative, yes, but it's a tangible business in a booming sector. The demand for EV charging infrastructure is not going away. It's going to grow for the next decade. Pioneer is a small but nimble player that is winning real orders. For an investor who can handle some volatility and is willing to do their homework, I'm calling PPSI a buy. It's a speculative buy, but a buy nonetheless. Let's stay in the energy space and talk about a much bigger and much more controversial name: Sunrun, ticker RUN. This is the biggest residential solar company in America. They install solar panels and battery storage systems on people's homes. Their business model is primarily based on solar leases or power purchase agreements, also called PPAs. This means the homeowner doesn't have to pay the huge upfront cost of the solar system. Instead, they pay Sunrun a fixed monthly rate for the electricity the panels produce, which is often less than what they were paying their utility company. It's a great sales pitch, and it helped Sunrun grow into a giant, but oh, how the mighty have fallen. Sunrun was a market darling a few years ago, with the stock soaring to nearly $100. Today, as of August 2025, it's trading around $14. What happened? A perfect storm. High interest rates are the #1 villain. Sunrun has to borrow a ton of money to pay for all those solar systems they install, and higher rates crush their financing model. Secondly, a policy change in California, their biggest market, reduced the incentives for homeowners to go solar. This combination has slammed the brakes on their growth and thrown their entire business model into question for many investors. The company's financial performance has been a mess to analyze. They have a lot of debt, which is a huge risk in a high interest rate environment. They talk a lot about subscriber value and other complicated metrics, but at the end of the day, the company has struggled to generate consistent positive cash flow. The bears, the people betting against the stock, will tell you that the company's accounting is confusing and that their debt load is a ticking time bomb. The bulls will tell you that the stock is incredibly cheap based on the long-term value of its customer contracts and that the shift to clean energy is an unstoppable trend. So, what's the verdict on RUN? This is a tough one. The stock is beaten down, and it could be a classic value trap. Something that looks cheap but keeps getting cheaper. For a new investor, the complexity and the debt load are too risky. I have to call this a hold. If you own it, you've already endured the pain and there might be a recovery. But I wouldn't put new money to work here until we see clear signs that the storm has passed. Last but not least, let's look at a name from the past. FOSL Group, ticker FOSL. Many of you will remember FOSL. For decades, they were a powerhouse in the world of fashion watches. They designed, marketed, and distributed watches and accessories for their own brand and for other big names like Michael Kors and Kate Spade. They were in every mall, in every department store. But then, something happened. The Apple Watch. The rise of smartwatches led by Apple completely disrupted the traditional watch market. Suddenly, a watch wasn't just for telling time or looking good. It had to track your steps, show your messages, and pay for your coffee. FOSL's stock price tells the story of this disruption perfectly. This was a stock that traded for over $130 a share about a decade ago. Today, it's trading for under $2. It has been an absolute train wreck for long-term shareholders. The company has been trying to pivot. They've developed their own line of hybrid smartwatches and have tried to focus on their core strengths in design. But they have been fighting an uphill battle against the tech giants. Sales have been declining for years, and they have been closing stores and trying to cut costs just to stay afloat. When you look at FOSL's financials, it's a grim picture. They are losing money, and their revenues continue to shrink. Every earnings report for the last several years has been a disappointment, a story of declining sales and widening losses. What's my final call on FOSL? For a new investor, this is an absolute sell. Don't try to be a hero and catch this falling knife. There are far better places to put your hard-earned money. This story is over. So there you have it, folks. We've gone through 8 different companies, 8 different stories, and 8 different sets of risks. Let's break it all down. The market is a complex machine, and not every stock is created equal. Some are primed for growth, some are pure gambles, and some are just broken businesses you need to steer clear of. Your job as an investor is to know the difference. Don't just throw your money at a ticker symbol because you heard a rumor. Do the homework. Understand what you're buying. That's how you win this game over the long run. Out of this entire group, the one that stands out to me as the most promising for a new investor with a stomach for some risk is Pioneer Power Solutions, PPSI. It's a real company with real products in a sector, EV infrastructure, that has a decade of growth ahead of it. It's a picks and shovels play that doesn't rely on the success of a single car company. It's my top pick of the bunch for a small, speculative position in a diversified portfolio. Then we have the high-risk category. Perfect Moment, PMNT, SRX Health Solutions, SRXH, and Sunrun Run are all very risky but have plausible though difficult paths to success. They are for more experienced investors. The Biotechs, Biotech, IOBT, Precigen, PGEN, and Matinas Biopharma, MTNB, are in a league of their own. They are binary bets, pure speculation on science. For 99% of investors, these should be avoided entirely. Finally, we have the stock to avoid at all costs. FOSL Group, FOSL. This is what I call a value trap. It looks cheap, but it's cheap for a reason. Don't be the person who tries to catch this falling knife. There are thousands of other companies out there with brighter futures. Your mission is to find those, not to try and save a sinking ship. So be smart, be patient, do your homework, and you can find the real explosive winners for your portfolio. Booyah!